Alrighty, we are up and running. Right, a couple of things to cover off to start with. Month end is today. Up to you guys whether you want to trade it. The nice thing about month end at the moment, or this month, is that at least with the clock change, if you're in Europe, it's all an hour earlier, which compresses everything together. I've got all of the tradable month ends up there. Brent, obviously you guys can't see Brent, but I'm sure you all know that's another oil contract. You will see an impact on WTI around about the 420 to 430. It's going to be, I would assume, reasonably subtle. It's not exactly going to be the easiest thing to actually trade. So whether you bother with that is up to you. Personally, I'd be looking at the European equity close at that time anyway. But what I've got there is all the timings that you want to be watching. That's the basic window of when the trade will happen.
Factoring in the daylight savings?
Yes, yeah. So these all factor in daylight savings. So obviously for these ones, gold, oil, treasuries and S&P, you have to add an hour back for the next one. So for end of November, you would add an hour on to these.
So next month we had the
next
week we had the
Yeah, so all the closes will change by an hour next week. So yeah, just bear that bit in mind. But that's all your timings for all of them. I'm just thinking about to try and give a bit of a sense as to movement. The FX is probably the trickier. With FX, what I would do is make sure you're watching at least the euro and cable, and quite often the yen as well. Reason being, you don't know which one's going to be the one that moves. There's been periods, and with all of these types of things, I'll perhaps do a session on this in order flow week. With all of these types of things, they go through sort of cycles of being good. So there's been periods where you'd always trade cable on the month end, then periods where it's euro or it's yen. So you've got to kind of just track these things. Simple thing, at the end of tonight, just get a 1 minute chart of the last half an hour or last hour of trade in all of them. That way you'll start to see patterns start to appear. And if you just compare them every single month, you start seeing the size of the moves, when the volume starts to pick up, what the delta does, all of those types of things, just factor into your ability in future to go, okay, I want to be looking at this. Yeah, there have been times when the FTSE was the thing to go for. I've seen periods where Bund has been dire and then Bund has been brilliant. The most consistent ones that you could sort of go, I reckon I've got a chance, I would say are oil and S&P. They always have a bit of movement. The degree of movement is, yeah, that's the debatable part of it, but there is pretty much always a movement.
Do you think that it's likely, given that the election is literally like next week, that there's probably going to be more impetus for people to...
What gives me hope for this one, if you will, is yes, I think there's possibly a bit of that factoring in. Yeah. There's a lot going on next week, so yeah, there is that sort of proximity of events. The other thing is what seems to be reasonably swift pickup in volatility really since yesterday. So that has added a fair bit. You know, look at say the S&P, we're in a completely different place now than we were for the last three weeks. So things have moved, bonds have moved a lot as well. So if there's a case of people needing financing, the prices you're going to have to pay to borrow money have all jumped up in the last, well, actually with bonds really in the last month, they have pretty much precipitously dropped, and then they've really exaggerated that. So if it's a case of funding, even on a really short-term basis, a couple of people have said to me on Teams today that a lot of this move is driven by short-end UK rates. That's the thing that's driving stuff. So if rates are starting ticking up, if you need to fund yourself over the month end or you need to borrow some money, it's getting more expensive. So it may be easier to sell assets. As I said yesterday, the one thing I don't do is go into this with well, you may need to sell assets because it's more expensive to fund, therefore it's a sell in the S&P.
Right.
What I'm really watching for, and with the S&P in particular, start at 745. If nothing happens, and when I say nothing happens, what I'm looking for is very distinct flow. I know we've not done order flow week yet, but what you're looking for is the ladder will get a lot thicker anyway. You won't see it like it is at the moment, like double digits. You'll start to see it thickening up. It'll be triple digits on most prices. And you'll then start to see, let's say it goes up, quite a sort of clear, it will bid, hit the next offer, and then it will move the bid up. And it'll hit the next one and it moves the bid up. It kind of steps. It then doesn't, if people come and sell, they can't push it down. You can kind of feel that sort of holding, ratcheting up or down, whichever way it goes. And it doesn't feel like it can ever get off the low or off the high, whichever way it's going. As soon as you start to see that or sort of get that sense, that's when you want to get involved. The other thing with it as well is assume that it will run. So let's say if you're selling the S&P, you've got in a, I don't know, 746, assume that will go until the close. The aim then should be to build position up and stay in until the close. Don't try and...
How close to the close?
With the S&P, that's a good point actually. With the S&P, there are varying different approaches to this. Generally, with 30 seconds to go, you start to scale position down. So start to lighten up with 30 seconds to go. I would always keep something until the actual close. So it ticks over, get a clock on your screen, it ticks over and you will often see that it does this flush down right on the close. And what my strategy on it is always, as you get to the close, let's say you're going down, draw in red. Tick, 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 down. That's the close, don't know why I've got a line on it. What I would always do is, when you get towards that sort of close point, whatever size I've got, I would then bid like that to double the size. So if I'm 10 short, I'll get 20 lots worth of bids on the basis that if it does the flick, it will do that. If you get really lucky, it fills you all out and all back. And by the time you notice, it's here and you've got 10 lots long from there. That's the kind of perfect scenario. It doesn't always play like that. It may be that you don't get them all. It may be that you only get 8 of the 10 that you're already short. But the whole idea is that as it flashes down, you're getting out and trying to reverse that. The other part of the approach is you get your bids down there, and as it flashes down, you hit market. So you're trying to hit the lowest offers that drop, hit them and it flicks back. So that's always been my approach. I would always give it the second after the turn to do that rush down. That's the main thing that I would always look for on that. Most of the others, and yeah, actually I say this broadly for most of them, you will typically get some degree of reversal if you've had a very clearly directional move. Just on the basis that, well, if the market's gone up like that because of the month end, once everyone's got that business done, this effectively is artificial. There's no reason for it to be here apart from people need it to do some business. So once the business is done, down it goes or back it goes. Doesn't have to go all the way back, so don't get greedy, but just, that little bit of reverse.
If the day prior to the close has been a big move, would you let that affect your expectations of? Directionally,
no. Expectations of movement, yes. But I generally try not to put any kind of directional bias. I've done that before and gone, I think it's going to go up because, it's been selling all month, so surely people are going to bid it up on the close, and it doesn't. The main kind of correlation, if you want to anything, for me has always been the greater the volume on the day going into month end, the better the month end move. So the kind of line, obviously it's an hour earlier now, so that will affect the volume because it's not had so much European session trade. As a general rule, if it gets to normal times, basically an hour and a half before the close, so when the oil closes, I'd be looking, if the S&P is over 2 million contracts already, which is already bigger than a normal day, I would assume a good close. If it's not, it could still be a good close, particularly on a month end, but on a day, if you were just trading not next Tuesday, it's your selection, next Friday, unless you've got an exceptional amount of volume, I wouldn't be thinking, I definitely want to stay for the close today. Yeah. But if you see a sort of very distinct pickup in volume, closes are usually good. So that's the kind of general rule in it. So that's all the timings. Obviously, work out for yourselves which of those you want to trade, whether you want to stay up if you're in the UK to 8 o'clock. At least it's a Thursday night. It's not like it's a Friday. The worst one is New Year's month end. If you're stuck in the office on New Year. Also, the other problem with New Year's month end is markets don't close at the standard time, so you have to look them up. And the other part of New Year is because it's then a holiday or a weekend, it closes bang on. There's no post-close trade, particularly in the European markets. It's shut, bang, gone. So if you don't get out on that last 10 seconds, you could be in over the weekend, which is not nice. Which forces you to then get out of prices you perhaps don't want, but you're better to be out than in for no reason.
Would that be a stressful weekend?
Yeah, it's really important to know the timings on those ones, or just don't bother. There's an easier way. It is New Year, go and enjoy yourself. Right, so that's the first thing. Second, I'll cover a couple of the questions and then I'll cover the task for tomorrow. The other thing to say about tomorrow is it is non-farm payrolls day. So we've got payrolls tomorrow. We'll be running live trading floor on that tomorrow as well, which is essentially myself and Eric giving some commentary and views on what exactly has been going on, why traders are in certain positions, what they're doing, all of that type of stuff. So afternoon session will run at a slightly different timing schedule tomorrow. We'll probably start at 2:30 rather than 2, and I'll give you the answers to the task. I would also suggest, being as it's order flow week and next week, trade non-farm payrolls. Have a go at it. Whether you understand payrolls, whether you know what it means, whether you care what it means, doesn't matter. Have a go at trading it, because the volatility it creates huge tradable opportunities. So go and have a go at it. You can do it just straight from an order flow perspective. Forget the number, forget the charts, and trade what you see. That's one approach. The other approach is trade it based on the number and what you think that means. We will do both in the coming weeks. We'll cover different ways that you could trade these types of events from an order flow perspective. And we will then in week 4 do a how do you actually prep for the data, what do you do on the data, how do you trade it, etc. So go for it however you fancy, but go for it. See how you get on. And I'm hoping then by the time we get to CPI, everyone's going to perform well on the data. I would expect some reasonably mixed results tomorrow between various people. Right, let's get to it. Okay, so that's month-end timings. I'll quickly cover a couple of these questions. Do people typically use one chart as their primary to develop and execute most of their trades, or should they be well versed with strategies on different chart types? For example, if I usually want to execute based on a 1 minute to 5 minute footprint order flow, and maybe along with DOM or a heat map book map, is it still important to have a thorough understanding of profile strategies, or is it viable to focus on footprint strategies to get consistent while understanding only basics about profile? The first thing I would say there, if you can only focus on footprint and become consistent, forget everything else. You don't need it. Just do that. I would be inclined to suggest there's very few people who can. So yes, I think it is imperative that you understand. Don't look at these as strategies. Profile is not separate to footprint, it's not separate to candles, it's not separate to anything else. Don't look at it as, well, I could just trade from this or that. It's much more a process of what are you using these things for and how do you use them together. A profile's not going to give you defined, really clear execution points. A profile is going to give you a sense of the nature of movement, where you're likely to go, whether you're going to be quick, whether you're going to be slow, the sense of whether we're ready to move. S&P today is a good example. We've spent days and days and days doing nothing, and we now got away from there, and all of that sort of energy, if you will, gets dispersed and the market really starts to move. So you've got to sort of combine them all. For me, and we'll do this in week 5 anyway, but the way I kind of look at it is I would use different things different ways. So first off, I would have a daily chart. That just gives me a sense of sort of range and change. What I mean by that is whether you've actually done anything different. If we're still sitting within the previous range we've been trading, a daily chart's pretty useless. Get rid of it. So I don't suggest you sit there with daily charts up all the time. You just need a daily chart to be able to go, okay, we are now beyond a certain point. We're past a certain point on the downside, on the upside. Now I can be very clearly directionally biased. The next thing I'd have is a profile. This gives you a sense of structure and timing, on the basis that what that will give you is the ability, let's take the S&P yesterday. You've had 3 days of sideways, you get out of it. If it starts to run directionally, completely believe it and you can play for it. If you're looking at something like the Bund from yesterday, which had a really, really distinct large move, straight away today, I'm already thinking this is likely to be muted. I want to be selling resistances on the way back and just trying to trade it up and down the range. So it gives you much better sense of timing as to what you want to do on a day-to-day basis. I then have a 60-minute for what I call scope, as in where exactly can you get to. There's no point in looking at the S&P on the daily and going, oh look, there's a level down at 5,400. You're not getting there. There's a lot of things in the way. Get a 60-minute up and you can then work out the different places you can go along the way. So that's the main thing with a 60-minute. So it just gives you a sense of scope, and also sort of big levels. It's very easy when you get on short time frame charts to get sucked into going, oh, that's a level. It's not really a level. The main level is 01, and you're looking at something that's happening at 05 because it's just chopping around in that area. Don't get sucked into those. This ultimately is going to help you make a decision about what you want to do, where you want to go on the day. So you've kind of then got a line between that and then what I would then call execution. So 5-minute charts give you patterns, risk, if you will. I.e. for a 5-minute chart, you can define where you want in, where your stop's going to be. Let's say you've got a big 60-minute level and you've got a 5-minute chart that looks like this, and that's your big level. I'm looking at that thinking, I definitely want to play this, because if that breaks the flag, it gets you to there, which gets you to break on the 60-minute. That's why I hate targets on flags. I think it's rubbish. If this flag's got a target of 20 ticks and 20 ticks takes you to here, well, you've just broken a major level. It's not going to go 20. It's probably going to go 50 down here. That's why I don't like targets. Short time frame stuff just facilitates playing the bigger move that you're already looking for. You could use that as a 5-minute or a 1-minute. You've then got a footprint, which gives you accuracy. Accuracy and expectations. When I say expectation, what I mean by that is if you're sitting on a footprint, every time you go to a certain level, somebody just absorbs and absorbs and absorbs and absorbs. Well, what you can then do from there is go, okay, if that's the case, I know what needs to change next time. If it goes there and they don't absorb it, it's going through. If it goes there and they absorb it, then you're probably going to get the same again. So that's what the footprint does. And it gives you that kind of precision that it's exactly that point. If you go off a chart, you'll often find, let's say you've traded and done that. The chart shows you, that to be the level, but on a footprint, you actually see that really the main buying was say there, and that was just a little flick down. So when you come back, you're then thinking, well, actually, I'm better to buy here with a stop below there than I am to try and buy the low, because you probably won't get it. That's what I'm using a footprint for. And then on the back of all of that, then I would go for a DOM, a ladder, whatever you want to call it, and that's your execution, the kind of final check. Because you can see whatever you want on any of these things, but if it doesn't show it on the ladder at the point you want to execute, it doesn't matter. You don't want to do it. So that's how I do it. So I don't think you can just go and do one thing or another. Yes, you can focus more in certain areas and you can be more, your decisions get made more off a footprint, but ultimately a footprint's useless if your footprint's saying buy it, but you are currently in a market that is breaking through daily lows and is rushing to the downside. It doesn't matter how much a 1-minute, 5-minute footprint says buy it, you're buying catching a falling knife. It's going to go wrong at some point. So you got to marry the sort of the different things up together rather than just have one skill over another. Likewise, profile can tell you a lot of things, but if a big piece of negative news comes out today for European bonds, it doesn't matter that from a profile perspective, I'd be saying this is a balanced day all day long. It's not going to be a balanced day. It will fall. So you've got to combine all of those things. But that's how I'd kind of try and break those things up to answer that one. And like I say, if you can get consistent results in anything, just do that. It's not to be churlish, but I don't think anybody can. Anybody who's got one tool and consistently makes money, i.e. day in, day out, nobody does. I think the closest you could probably ever get to that is someone trading off a ladder. It's probably as close as you're ever going to get. If you can trade off a ladder, you can just scalp. Difficulty there is to be able to do that. You've probably got to have been trading for long enough, meaning you probably know enough about the rest of the stuff to actually be able to have that level of skill, in which case, well, by that point, you've got all the rest of it, so why are you only using one thing? Right, I'll set out the task and then we'll come back to, no, I'll just touch on this one very, very quickly. I can't remember who sent this one in, James. The 45-degree line on the treasuries from yesterday, yep, absolute classic fat bottomed profile. You could almost call it a Christmas tree if you really want to. If anyone's unsure, it kind of looks like half a Christmas tree. I'm semi-alright drawing of a half a Christmas tree. That's the idea, that basically you spend a lot of time sitting down here achieving nothing, and then as you move away, we then just drift towards the upside, which is what you got the day before and then you got yesterday as well. This is a full session. This is just cash session, so there you go, you get that. What you're aiming to do is try and find, and this way you bring it down to a shorter time frame, you try and find out a sort of range down here that you can play out of. So in this space, on this one, you're kind of looking down here. You've got that. Once you break out of it, then you're just playing for this drift higher, which is the general goal behind the trade. Once you've had that, if you can fail to go up, the attraction is still down because value is still down here. So the day after this one, you're looking for that to get dragged back down. If it doesn't drive up, it gets rolled back over, which is what's then happened. Key thing today that you need, well, I put this up, but I think you've probably done it by now. The thing you need today, if this is going to break, it needs volume. Talked about this one yesterday. I would suggest at that point in time, it's got the volume. So if you fancy the breakdown in the T-notes, it was there for the taking because it had the volume to do it. And then you're looking really, as long as it stays below sort of 110.13, 110.14, it's looking all right for it, which it did, and it's now starting to bounce back.
Was that the 92 level?
T-note? There's no 92s in T-note.
Is it in?
Yeah. So that was the low. There's your sort of 13s area. You're looking to play that through the low. Well done. T-notes don't have a 92. It might be the way if you move your crosshairs on the chart, it will be 09.5. And just remember, it trades in 30 seconds. So it will trade 09.5 all the way up to 31.5, and then it will switch to the next big figure. So it'll be 31.5, double O. Just bear that in mind. Sorry?
It doesn't show the price when you put price on the line, so you go,
if it's not the round number, it's a half. The T-notes only trade in half, so it trades in 40 seconds, it's 64ths. Just to make your life nice and easy. Right, so there we go. You've got that breakdown now. What it has done though is broke down, flushed everybody out, and you're back inside this area. Don't rule out, if it finds a bit of a support zone here, that it can't do the same again and just drift its way back up to here to sort of 24. So I wouldn't rule that out now. Seems all the bonds had this flush out and now they're starting to bounce.
From a market profile perspective, 65, that's a 4 high. Well, would you count that if it's not, the profile's not formed? Like today's one, yeah.
But I've got today's profile high is 18 and the low here was 10.5. So there isn't the 65. You're talking 06.5 here. The only thing, my issue with bad highs and bad lows on treasuries is it doesn't have much range, so you will often end up with it bumping on the same points. I don't put too much weight on treasury profiles, if I'm completely honest. The hard bit with treasury profiles is they often will have these kind of very bad looking highs, bad looking lows, but also
they don't have much volatility, so you can expect that.
Yeah, one, you can expect that, but also the treasuries open 10 minutes before US data. So you can have some days that have got an absolutely gigantic initial balance and then does nothing on the back of it, which I guess does make sense. Huge initial balance, do nothing. But then you get this kind of, you'll have some days, you'll get a lot of days like this, then you get one day that opens here and the initial balance is there and that's it. And you've just wiped out all of this. Personally, I would lean more to a candle chart on treasuries. Right. Let's explain tasks for tomorrow, then we'll go and touch on a couple other things, which is also part of a kind of. Right, so tomorrow, you guys dug your own graves by sending dates in, so I'll explain that in just a moment. Hypothesis building. This, going back to what I was saying on the previous question, is ultimately how I would start every day. The idea is to try and build up a hypothesis of what can happen. This is not to say one thing. You do not want to get yourself stuck blinkered down. It's going down, because if you do that, you end up stuck. That if it doesn't go down, you've got nothing and you don't know what to do, you don't know where to go with it. So the idea generally is to create 3 hypotheses. Obviously a market can go up, it can go down, it can go sideways. But what you can ultimately then do is break these down and go, well look, it might go up, but the probability of going it up your assessment of the chance of it going up is very low. So, well, that's unlikely, could happen, it's going to do this, it's going to do this, it's going to do this. So you can give yourself a degree of bias to start with, but you at least need to be open to the possibility of a market going up, going down, going nowhere, rather than just going, well, I think it's this. People too quickly jump to easy conclusions. They don't harp back to the bund, but you go bund, you look at what it did yesterday from a candlestick perspective, and it's a massive red daily candle, and you go, ooh, that's bearish, sell it. From a profile, it suggests it's probably not going to be that. You're then at least giving yourself a degree of structure around going, well, it could go down, but it needs to do this, 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 and then it goes, or it doesn't, we balance. I would say there's a very low probability of it going back up, which I'll explain with it. I've got a bund one up. I'll send you guys over a sheet to kind of make sure, one of the things to do is have consistent metrics that you check off. People talk about consistency. It's not results, it's the things that you do. If you do the same things every day, you're comparing the same stuff every day. Therefore, you can spot differences. But if today you look and go, oh, it's a gap, and tomorrow there's a gap, but you go, oh yeah, but value is up here, and you don't look at the two things the same, you're never clear on what it is that you've got right or wrong, or what's really inputted into your decisions. You're just looking at going, well, I found a reason to play it back up, or I found a reason to play continuation. So first up, key thing, I'm looking at any key levels, which you're going to get off a 60-minute chart. Also, what was yesterday's day type? I sent the summaries through yesterday. I'll send some more, or I'll send the same ones back again so they stay closer to the bottom of the page. I will see if we can actually just get them loaded up onto the career page. So get down what the previous day type is. What this helps you with, by looking at previous day type, previous close, is it helps you with being able to say, well, this is my base case. For example, there's some reasonably standard kind of patterns. Trend days are usually followed by balance days. Balance days are followed either by another balance or a trend. You've just got to work out which one it is. Liquidation days are followed by either a continuation move or a liquidation back. Double distributions either fill the cave in, or they hold above one side or below the other side and continue. So you've got at least a base of, well, if I see this, this is where I'm leaning, what's going to change it? And that's the way I try and sort of start off from. The next bit is then a question of, well, what do you know so far? When I'm doing any kind of prep, I would start on a base case here. You could do your prep pre-open, but then you've got to have a base of, right, well, this is my assumed results. Once you've got the initial balance, you can now go, okay, well, it's clearly showing it's this or this or this. I don't think it's worth doing the night before. Other people have arguments that it is. From experience myself, I've tried doing this, thought, well, that's much more efficient. I just do it the night before and then I'm ready for the morning. Well, one, you miss the overnight session, but two, then you come in and you still end up going back through it to make sure nothing's changed. In which case, I don't think you're really achieving a great deal apart from elongating your evening and still doing roughly the same amount of prep in the morning, which then starts getting you to question what you thought yesterday. Do you still believe in what you said yesterday, or are you now thinking something different? Well, personally, I found that difficult. I found that I just ended up confusing myself and ended up with less conviction on ideas the next day than if I just came in and went, right, this is the information I've got, this is what I think is going on.
How early do traders come in to prep for the, is it an hour before a substantial amount of time, or hour and a half?
I would say most people don't have longer than an hour worth of prep. Bearing in mind that you don't have to prep the S&P at 7 o'clock in the morning. If you're coming in at 7, it's really just to make sure you prepped for your bund, Euro stocks, things like that. And then you cycle that throughout the day. So there's nice periods. 11 till 12 is a good period because that's when everyone in Europe goes for lunch. That's when people, if you've woken up early, start getting hungry over here, it starts getting quiet. That's a good time to then start doing your prep for the S&P, for oil, for gold, treasuries, whichever one you're going to trade. So you get these sort of broken up bits of time. The other thing, prep always seems long-winded when you try and explain it, because you're trying to talk through like what's happened, why you would interpret this like this, like this, like this. If you were trading yesterday, you know exactly what your market did yesterday. So you already know the key levels. You already know the way it traded, what it looked like, what the profile was like. So you've answered most of the questions just by being there yesterday. It's just to try and explain that and sort of explain the process takes longer. So key things that you're interested in when you come into a new day, once you've got your kind of base case, is then what's your initial balance suggesting to you? Does it suggest anything? Has it got you to anywhere different? Are you opening inside, outside of value? Are you opening gap or not? Those are the questions that you need to be asking. That helps you then go, okay, well, I can also take my time or I can't. You know, there's going to be some days where you come in and you're looking and think, I can just step back, leave this alone until we get to a certain point and then I make a decision. There's going to be other days, S&P today, for example, where if you thought this might be a sell, you needed to go for that straight off. And if you didn't, well, you could have kept chasing it, but it became a very, very nervy trade if you did. You had lots of whips back in it, etc. Final thing then is you can create hypotheses as to what's going to happen. The idea behind this is that crucially you want to be able to have a line in the sand on these and where I would also call it in play. So the idea here being that you said, right, I think if we go past this point, it's a trend day, which means you don't think about all the other things. It could go down, this could happen, this could happen, it doesn't matter. If you're beyond a certain point, it's a trend day. So you then play it like that. What you're trying to do is just cut down other things that it could be. So a kind of case of deduction. If it doesn't go down and starts breaking higher, well, just forget anything that's about going down, play it to the upside. I'll give you an example of what or the way that you would look to do this. When I send over the task for tomorrow, because what I'll do is I'll send you over a profile, which will probably have a number of profiles on it. I'll send you over a chart as well. Most of them, I would typically send you a half hour or an hour chart, and then a profile. And going back to what I said before, this is about you being able to go, right, I think it's going to move from here to here. It's not precise points of execution. It's a broad idea. If you go past this point, we're going here and we're going to range or we're going to trend with whatever. This example, this is a DAX one. So something a little bit different from most of the things we talked about earlier on. What I'd be looking for, so to start with, and I'll send over this as well, which is a good way of kind of just tracking different metrics. Obviously you don't have to colour it in, it just looks nicer for here, but print it out and just circle things if you will. But yeah, I'll send that over to just give you a way of breaking these things down. I'll talk about it a bit in a moment. So what I'd be looking for then is I want to be looking to start with, what do you already know? Well, yesterday was quite clearly a double distribution day. We traded up here, you then had this quick drop, and then we traded lower. It's also, and this is where it's worth looking at candlesticks, a very large bearish engulfing candle. These were the previous, well, that was a Wednesday liquidation, balance, 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 open higher and reverse the entirety. So you've swept out 3 days. You've got single prints in the middle. You've got value, and this is important, value left higher, no value lower. But close is lower, the open's down here, value's up here. The other things that I'm looking for as well is you've got a gap all the way down there, which is useful because that suggests that if it starts to go down, you've got a lot of open space to fall into. So there's some good scope for movement there. On these 3 days, the bottom of the range is 00, and you've then got this other low at 25, which is basically there and there. So you're starting to pick out your sort of key levels. You've got 25 and you've got 00, and then you've got the gap all the way down here, 250 basically. You're opening at 360. So that's roughly the sort of key bits of info that I'd be sort of taking out of it to start with. The next bit is, well, what's happened so far? Well, what you've got is an open drive. So your open drive up there, it's an open drive, it's closed right at the top. That's dead clear, definite open drive. That's it on a 15-minute for what you've got so far. So you've got that little bit of clarity. It's giving you a pretty bullish open. And you've then got the other facts that are on top of it. So then what you can do is start to roll this out into, well, what's the implication of this? That's always the key question. It's all well and good being able to go, yeah, we've got single prints, we've got, yeah, I can identify the day type, I can identify the open type. Well, what's that mean? What are you going to do with it? This is where I brought this sort of sheet in, so you can go through what yesterday's day type was. The idea behind that is that gives you a base idea of what the next day's scenarios are likely to be. Yeah, I'll send this over as a PDF. Market's previous direction, value overlapping. That's quite important because that then allows you to go, okay, well, yeah, you have a double distribution. Yes, it was down. Value's not shifted. Yesterday's close versus value is what I would call an extreme outside of value. I'll send over the abbreviations as well. Actually, I think I've got it on the sheet. So generally an O means out, or OS means outside, IS means inside, V is value. Yesterday's close versus previous lower. A lot of these things you're going to know, and I'm not saying that this is something you would then have to do every single day. It's just to make sure that you've considered these options. Even if you didn't bother filling it in or anything like that, as long as you've kind of gone through these sort of checks, okay, yeah, I know what this means now, or I know where we are. What you know so far, it's open below value, open relative to previous close, it's in line, it's an open drive, it's up. The initial balance size is average, there's no overnight direction, so you've got nothing to say on that. The next bit I'm trying to look for is your hypotheses of what can happen. The other thing that I'm interested in on these, and again, this is more something you're going to kind of think about anyway, the in play and line in the sand, I think it's worth writing down. The type of move, what I mean by that is your expectations on how it's actually going to do it. If this is a cave fill day, it's going to move into the single prince and trade and cave fill, it's just going to be a rotational day. So you should see a day that slows down at highs and speeds up at lows, or it slows down at lows. If it's going to be a trend continuation day, then it's going to be quite steady, but it's not going to bounce off, or it's not going to bounce off any kind of support. It's just going to drive and drive and drive and drive. This way then, what your aim is to be able to go, right, well, this is in play at X, this is the line in the sand on it is the point where you can go, this is just not happening anymore. You completely don't believe in it. It's not an option, which is good because the quicker you can get to that, you can then mark certain ones off and go, it's not that, it's not that, it's not that. It must be that. Great for conviction. Which then leads you to being able to sort of develop these types of ideas. I'm probably not super clear, but I'll try and explain them. Hypothesis one is the fill the cave idea. So this is kind of a liquidation type trade. You've got an open drive already. The point where I would say this is in play is once you've got over these previous lows. So once you get through double O, I'm thinking this is in play. You can play this to the upside. The idea there being that, well, value's up here, so we get attracted straight back to value, meaning that this could be quite a quick move, essentially catching out the people who sold it looking for the next leg down. That's in play there. It's one where until you get to this point, and as long as it stays above, it's in play. Anything below double O, it's not in play anymore. So it's not a line in the sand. The line in the sand on this is the break of the low. If it breaks the low, you can't play the liquidation up anymore, because on the sort of profile theory, the IB calls the high or the low. If it breaks the low, it's not a liquidation day. It's not going to go and trade through here and do that, which would be what I'd expect. If it trades through, I wouldn't be surprised if it then does this. So that would be the first idea on it. The second idea is just a straightforward consolidation balance type day, that if you've traded up here and then you've moved down here, this area acts as a resistance. You've got single print, you've got previous low. There's no value down here. Doesn't mean that value can't establish down here by just trading this out the next day. So then be thinking, right, well, any movement into here is a potential sell. This is one where this is in play straight away. You could play for this immediately. You could play the sell here. You could play a fail break of the open here and just play the rotation like that. The only point that this is sort of no longer in play, your line in the sand, dependent upon how far you want to stretch it, you could say above the single prints or above 25. I'd prefer to say above the single prints so that I'm not still thinking, oh, well, maybe it will reverse once you're inside. Once you're up here, my view is this is only going up. It's going to go and fill the whole lot of it. The other side of it is on the downside, you break yesterday's low, it's also definitely not. So that would be sort of idea two, which is the only one that's really in play straight away. And then the third one is a second day trend. You've got the huge bearish candle. You've got, if you really want to stretch it, you could call that a flag. You could call it a pennant, however you want to do it. You're holding below the single prints. You've got a gap to fill below. There's reason to believe it could do a second day trend. That, to a degree, is in play. It's one where, and this is probably the most ambiguous of in play, it's only really in play once you break the open, because that's the point where you go, okay, it now can go down. So it's only really in play there or on a break of yesterday's low. However, you could sell it from here and the trade work, if you see what I mean. So that's not the point of entry as such, but you're almost playing it at the line in the sand and going, well, if I sell it here and it goes up, it's never happening. If you sell it here and it goes down, you could be in like the best position possible to play for that. So you're then, you're 50 ticks on side by the time it starts the trend, which has still got another 110 ticks to go. So it's kind of the best possible entry. By doing that as well, what that helps you do is assess the value of certain things. When I say the value, I mean how worth it certain trades are. If you look at this here, if you sell 0013 area, well, now you're giving yourself options. If you sell it here and it breaks, you're wrong, it's this one. But if you sell it here, it might be number 2, it might be number 3. At which point, you're then playing for it to do that, and then you make a decision here. It either breaks the low, puts in a single print, and you go, brilliant, I've called the high of the day, this is going down, gap fill. Or it gets here, it comes back inside, and you go, okay, it's not that, give it up. So then you look at it from that perspective, and you go, well, I've now got effectively, take away your bias as to which one you think is more likely or not, a 66% chance that I'm on number 2 or 3, just on the basis that, well, either the 33% chance of any of them. So that seems like a more sensible trade than trying to play the break. You only got a 1 in 3 chance that you play the break, and that is what happens, assuming they all have a similar weighting. You could also assign a probability to them, where I say that I mean your own personal perception of the probability of it happening, not anything empirical, because there's no, you'll really struggle to find an exact replica of this structure. You'll find similar scenarios, but you'll never find the same. So you then got to go and do it like that. I'll show you the result. I'll put it out there if anyone wants to throw it in the group, if anyone's watching online. Which one you think it is? Any of you guys got a preference?
Is this a day?
I think 2.
You think 2? Anyone else? Yeah, what's it going to be? Basically, is it going to follow the red line up, the blue line sideways, or green down?
Red line up.
Huh?
Red line up.
You're going up, you're going down, or you're middle. It's what we're after. Everyone. At least it's mixed. Someone's going to make some money. Yeah, exactly. Good from a prop firm's perspective, you will hedge yourself, so we're fine. We've made some round trips. One of you's done all right. As long as it's the same person who does all right each time, they stay, and the other people go, and it's good. Right, result was that a whole lot of balance, a whole lot of nothing. It was a terrible day. I really remember this day as well.
So no movement at all?
Well, it did. We opened here, we traded up,
yeah.
We traded back. That was around about it. I remember this day because I remember selling there, and the idea being sell 00, stop up at, sort of into the single prints. The fact it flicked up, you're like, well, that's fine. Happy with that. It flicks up, all good, comes back down. I was always looking for this is going to fall out of the sky trade. It's going down, it's going for the gap, this is going to be amazing, and it didn't. So, but you have to play that on the basis of, well, let's see what happens. Once it breaks the open, which is there, it doesn't go, it comes back inside, you end up giving it up sort of here somewhere. It's not a bad result, and you have to kind of accept that when you play that trade. The unfortunate thing with any day like that is you're not left with much else to do. Once it's done the balance, or suggests it's a balance, the only thing you really had left to do, bearing in mind you're not buying that because you believe it's going down through the floor, you can buy that pullback when it breaks the low and goes back up, you play that back to the middle. That's about your only trade left for the day. So it's a hard one in that sense. If you were of the view that this is going to be a balanced day and that was the way you were playing it, you'd still sell it up here. But when it goes down through the open and doesn't continue, you're more likely to then play the long there and then play the long there. So you end up getting it right 3 times, whereas you probably only get it right twice. And you're not going to extract as much out of it. If you play for the big one, you're going to have to wait for it to come back before you give it up. Whereas if you're playing for the range bound, it breaks the low and you go, that's probably good enough. You look for the reverse, you get in at a better price and play it back up. So you have to have that as a consideration in it. But there you go. It did it the following day.
I was going to ask you.
Yeah, it definitely did the next day. It did that, and then the next day it opened and went like that and did it. So you still, and that's the other thing.
Did you trade the next day?
Yeah, I do. I very much remember that one as well. Yes, it's done it. But yeah, that's kind of, and again, it comes back to that whole idea. You did this prep, you said it was a balanced day. Well, it's turned into a balanced day. You're now thinking, well, I know what's probably coming tomorrow. So as you go into the next day, you've pretty much already worked out what you're going to do. If it opens inside a value, break of value is your first possible play down. Break of that low, it's an inside day. You've got to sell that. If it goes, brilliant, you're all good, and off you go. And the fact that you've got this gap means there's just complete open space. It's going to do it. Yeah. And likewise, it would then essentially be the same again. That's your line in the sand. If it goes through there, it's the same play back up, and it liquidates all the people who got short here. It could, and you put the probability lower, but you could say it could just balance again. Yeah, if it doesn't break up and stay up, if it doesn't break down and stay down, it's another balance day. Like I say, I wouldn't be confident of it, I wouldn't expect it, but it's possible. So you have to always have that in your back of your mind. But on this day, I'd probably put the chance of a balance at least 50%, and then the other two are much lower. Yeah, the trend possibly because the move down, I'd probably put the other two at like 20 and 30% probabilities. The day after, another balance day, I'd put like 25% maybe, and then the continuation down, I'd put much closer to 60%, and then 15 for the last bit. You're surprised to see it rip back up, but that's how I'd kind of look at that. So what I'll do is I will send you over a number of examples to have a go at. We'll run through the answers to them in the afternoon as well. You also got payrolls to have a go at. But what I'll do, I'll send them all over a bit like this. I'll blank the dates out because I know somebody already put something about Nvidia and that's going to be a good day. Guess what? It's not going to be a NASDAQ chart on that day. It's going to be something you've never heard of. Lean hogs. It won't be hogs because I've got no idea how hogs trade. But it won't be anything NASDAQ or equity related. Or is that a bluff? So I'll give you it like that and then we'll go through the results of it afterwards. If people want loads more, I've done different ones for every group over the last 5 years. So if you really want 100 attempts at it with the answers, you could probably have them. But there you go, I'll send all of those over. Anything particularly relevant that I feel you need to see or need to know, I'll put up. For example, on this one, which was a DAX one, it's a cash session profile, but it was a full session chart, just so you could see, in this instance, the overnight part of it. And that's the post-cash overnight. You can probably guess what's going to happen here. All your values down there. That's what you're looking for. That was the exercise without the results. I've got the one with the results on, but that would be your main thing. Yeah, a trend on a day like this, you go, nah, that's probably not likely. And that would be your in play. As soon as it breaks back through the open, line in the sand, it's not going to trend onwards, and then you're very much playing for, that would be my main play. You just run the risk of the disappointment if it does that and comes back, and then you probably left yourself with a balanced day, at which point it's game over, there's nothing left to do. Right, I'll get those ones sent over to you a little bit later on. Okay. S&P. Well, we'll come to that one. In fact, I might as well bring it to you there.
Just looking at the odds, I know it's 61%. I don't know what the odds were yesterday, but maybe that's got something to do with it.
If you can see that the odds have shifted and that's the impact, absolutely, then you know what to do on election night. If she starts winning the swing states, you know what the S&P is going to do. So yeah, you need to have known what the odds were yesterday. She was definitely not favourite when we looked a couple of days ago.
61% now, so everyone's pretty shit themselves. So,
Nah, Trump's still favourite. 2-1 on.
I got Trump 34% coming over 61, unless I did the maths wrong. Trump 18, 15, how much on this?
Where are you getting that from?
See, it's 1 divided the first number plus the second number. Gives you a decimal that turns into a percent.
Well, 8 to 15 means you bet 15 and you win 8. Or 2-1, you bet 2 and you win 1. You've got, if you're going to flip odds over, they get exponentially, the probabilities turn exponentially in your favour as you go into the odds flip the other way. Yeah. Yeah, so Trump's definitely on. But yeah, S&P, I mentioned this earlier when we first came in, and so not for the guys online. I still think, looking at the way you're trading today, going to 25, I don't think is out of the question. In fact, I think it's probably, yeah, you're almost leaning to a point of going, it's probably quite likely. You're an hour and hour and a half in, and you've already got here.
What's another 30 handles?
Yeah, precisely. It's going to be a big disappointment for a lot of people if it doesn't get there, I think, today. You know, what's going to really stop you in here? Yes, you've got, there's something I was going to talk about today anyway, kind of mapping out what's happened. You've got a load of volume in here. So I was looking at, well, there you go, you've got just through the VPOC of this whole area, and you could actually extend this as well and look at it like that, or at least down to here. And then you're going, well, there's your kind of VPOC of the whole area. Whilst you're below that, it seems sensible to at least then sweep through all of that volume. There's nothing in here from a candlestick perspective that you would say, well, it needs to stop anywhere in particular in there. So again, that leans you to the idea that, well, as long as you're below 70, why not the other side? There's really not a great deal to stop you. From a profile perspective on the day as well, gap down, you've gapped, gap down, open, straight down, open drive down. It's left single prints here, it's left single prints here. It's shifted value in a big way to 85, then a bit more to 70, then a bit more to 60. It all suggests trend day. Yes, it's a very large initial balance, but if this doubles the initial balance, you're down to 30, which roughly gets you there anyway. It's got all the hallmarks of a trend day. It's probably not going to extend and extend and extend because of what it's done so far. Bearing in mind, the gap down was nearly 40 handles, or it was about 40. So you've done 40 handles down already. You've then traded another 50 plus. Yeah, you're starting to stretch how far it can go, but
Some changes, stay with it.
precisely.
Stay objective.
Absolutely. I think that's the real thing to remember, that yeah, unless there's any reason to believe this won't keep going, assume it will. The point where you perhaps start to doubt it, you've got bottom of the IB, very light volume 68, you've got the previous level 71. If you get to a point where you can question whether it's really going to keep going and make it to 25, I would say it's there. And then if it does fail, then it ends up looking like a more normal day, in which case you could try and sell 85, 89, and you can still play it down and you're still going to have some decent range in that. If you're selling 87, 88, 89 and playing for the low 50s, it's still a very nice move. It's bigger than anything you would have seen in recent days. So it's all good, it's just not doing the big straight directional move. So really it's just a case of adaptation of, are you selling for just continue, or are you now selling for rotation? Until it breaks here, I can't see how you can look for anything other than this is just straight down. And then a question of how far, which again, you start looking again, this is my whole point on using a 60-minute chart and giving yourself a bit of perspective. Yes, it could keep on going and going and going. And even if it gets down to here, that's what, 120 handles? It's not a massive move. It's only 2 and a bit percent. So you're still not into the realms of, in fact, it's 2% roughly, just slightly over. It's not a massive move. You could easily get, well, it could do 5%, of course. Is there any reason to really believe that? No. If it's going to do 5%, there's going to be some reason to do it, I would suggest, in which case you'll probably know that by the time it gets here, and then you will get something spectacular. I think this is more a case. If you can get to 25 or any kind of flick through that and you're short, I'd be quite happy to go, that'll do. I've achieved everything I want today. But this is the whole point that I was going to make today about sort of mapping areas out. I'm quite a big fan of just drawing your bigger profiles on. Once you've got to 25, then you've got to start thinking about what next. Yes, it probably leans to a more balanced day tomorrow. Take payrolls out of it, it's probably still going to be more balanced. But your next area, so then you've got these previous highs down here, you've got VPOC around there, which is 57.02. You've then got the bottom of this range, which takes you down to sort of 56.75, 56.70 again. So that's then your next area to go for. So you're just sort of mapping out the areas that you're going to get to. Like I said, there's no reason, I don't see why it can't just sweep straight through this. There's really not much, there's not much support in here. It's just a messy sideways action. And again, you could then extend this one even and just call that the entire range there, which still leaves you roughly with the same areas of support. And just feel like that you're in there, you sweep down the whole thing, which is always the case, even from up here, that every time you got down to the top of this range, it was getting stuck. And that was the area that it kept just pinging away from. Once you're into it, it's now the case of it's on its way. It's really just that question of how far there you go, you back down towards lows as well. Does it change anything massively? Maybe not. I think that's quite important to bear in mind. This is where you get a daily up, and where's that one gone?
So even if it breaks at 26, you would or closes below it, you would say that doesn't necessarily change.
No, I don't think so. So just trying to work out where that chart is. So I have a S&P daily chart and it's just disappeared. There we go. Yeah, so that's your daily cash chart. To me, that's, well, 57.27 could actually change things quite significantly. That is a pretty major level. So if it does break there, at least for a period of time, you could say this has got some good scope to go down now. This is just cash session. It would seem quite reasonable to start looking down here. Yeah. That's your 54.50s, 54.70. Yeah, I don't think that's an unreasonable scenario now. It's not had a breakdown for a while. To see it do this, I don't think that changes anything really big picture, and you're still very much on a huge run up. Yeah, if that drops down here and bounces, it just looks part of a wider trend, but it then helps you at least go, well, there could still be another 300 handles of downside in this. Don't start buying the dip too quickly. You got it here. This was that August? Yeah, July into August. The sell off there. You then had a similar thing at the beginning of April. You always get these phases of action. So yeah, 25 is going to be really quite significant, particularly if it does it with some decent volume. And on the volume point, it's not massive, but average volume recently for the S&P has been sub 1 million. The fact that we're already on, in fact, you're already over 600,000 just on the cash session today. You could be up to 1 million by 6 o'clock. You fancy it's going to be a good close. Just want to see a bit more action, a bit more going on. If it gets to 25s with an hour to the close, it could get really interesting. So that's going to pique some excitement, I think. Get people interested, get people looking. So we shall see what it does, how it works. Right, let's go to that one. This is the other aspect of the kind of mapping stuff out. What it's sort of cover is just by taking that step back and looking at what it's done recently. And again, you build this picture up over time. So whilst I might sort of explain it, you kind of see it, you know these things. Yeah, I think I talked about it a little bit last week, that the S&P constantly fails when it opens high. It does the initial balance up and then it just reverses it. And it does this really, really frequently. It just doesn't like being up there. You've then had the last 3 days of just compression of positions. So that suggests you're just building and building and building energy. What's interesting about today and what's significant about today is that previously, each of these days when they've gone down has put in a decent tail. It tries it and it turns it quite quickly. It's not like the tops where basically it just drifts up there and then just dies and rolls over. These ones felt, if you were trading them, like it had a much more distinct down, buy it back. You had all this just buying, and then it just turns. And the turn on it was quite ferocious. The fact that you couldn't do that today, and if you were watching it, and we were talking about it earlier, it tried it. It tried it a couple of times to sort of get to the lows. It pinged it up and it started and it failed again. That is something else that you would factor into the sort of significance of, or the potential significant move down, because the fact that it's actually finally overwhelmed that sense of ripping it back off the lows, which is what it was doing. Now it's not. Now it's on its way down. Then what I'd always do is go back to previous areas and go and have a look at how it's traded down at those previous areas, just to give yourself a sense as to what's going on. We're obviously trading 57.50, somewhere like that, 57.60. So we're trading down here now. So this is where we were. This was going into the beginning of August was the last time we were down at these points. What I'd kind of marked off was this was your area that just lacked value, and again it's the same game again. Every time it goes up, it just dies. People don't like buying it at the top, people like buying it on the pullbacks at the moment. So you got this zone. This was essentially where we started today. You started today, that was the area that is just not traded a great deal. When it went up, it didn't trade it. Any tests into it, it doesn't trade. And the one time it broke away from it was, I think, CPI day. CPI ripped it away from there. Sorry, this isn't August, this is October, beginning of. CPI rips it away from that area, and that's then the beginning of that move higher. So I did think there was a bit of risk that it could get stuck here. Once it's out of that, you're all good. I got this marked off here, 88 to 82, just from looking back over it, and you can see where it just constantly builds up volume. Very happy in this area. That to me was the way I kind of looked at it, was that's your last chance. If they can't defend that, it's game over. And they tried, because it went down, and then they did loads of volume today around here, around the sort of 88 to 80. Got stuck there, got stuck, couldn't get back out. That was kind of the key bit. If buyers were going to hold this, they needed it to bounce out of that to the upside. At which point, after that, what more reason have you got to buy? You're really struggling. And then that sets you in motion for the move down to the 70s. You've got 63. This area as well, these are those bad lows. You've got ledges down here on the cash sessions. Most of these lows, apart from this one on the second, were all done in the overnight session. There's a generalized rule, and I couldn't tell you precisely how true it is to form. There's a generalized rule that markets don't create lows in overnight sessions or highs. So this you would assume has at least got to trade it on a cash session. It's only done it once down here, whereas the rest of them are all a little bit above. The other part of it is this move off the lows was all done in an overnight session. You closed here and you opened here. So again, there's not that much strength in that move up, in my view. Yes, it tested back and it held the single prints, which is a reasonably strong sign on the day. But if it can't hold these things, if it can't hold this on a test, then there's not really that much support for it down here. And I would see that as then the opening up for the shot down. It's held it so far. I think the low of today is 55, or around 55, 54. So it is holding it at the minute. It's just then a question of whether it can actually get through that, in which case I think you've got those lows. But that's the whole idea of sort of just mapping a whole area out, so that particularly when you've not traded there for a while, when you come back there, you've now got a bit more of a sense as to what should happen. And so you can then have that sort of conviction from the break of 82, 81 that this is game on for the big drop. The other last thing that I was going to talk about, as a way to do it on a day-to-day basis, and I talked about this in some of the videos, as a kind of is a variation on card counting, the idea that you mark up positive scores for bullish things, negative scores for bearish. If you've got a clearly directional bias, as clearly everything says bullish, 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 it gives you no excuse, you've got to buy. Whereas if you've got everything saying bearish, you go the other way, they start matching each other off, then you go, okay, well, I don't want to go jump to conclusions. So you're just giving yourself problems there. So look at it like that. You could do it from that sheet that I sent over. You could just do it straight off on the day. So if you looked at, this was the Bund earlier on today, or just before the session started. What I'd be looking at is yesterday's day type. It's basically a trend day, but the thing that I would emphasize on that is a lot of this move was done post-close. I'd call that caught in the hole. If I was coming in at 7 o'clock, I would 100% be buying that. It obviously didn't work, but I'd definitely be buying that. Trying to play it back to here, here, and here. That would be the aim on that. Just because I think it's just gone too far with no volume on it. Obviously doesn't work, but I'm still looking at this from the view that yesterday's move, I would actually call that bullish. The move itself is bearish, but in terms of what you should do next, I think that's actually quite a bullish scenario. General direction is down. I don't think you've got anything there, particularly if you look at what you're doing on the day. So if you change this to what's it doing now, it's not doing anything. So that's a nothing. Value is completely balanced. That's a nothing. Yesterday's close versus value, that's bullish, or the same as before. Yesterday's close versus previous close is bearish. So that is quite significant that you've had that open trade down. So you're just trying to sort of stack up reasons to want to have any clear directional bias. And the more and more things you look at, the more and more things you go, well, I don't want to be buying this, I don't want to be selling it. And so you're just trying to sort of stack up reasons there. What it does help you with is if you have a situation like that, anything down here, probably a decent buy, anything up here is probably a decent sell, because you're getting yourself to the point going, well, I can't find reasons for this to go up here really. It's had lots of reasons to go up and it's taken none of them. If it was going to go up, it should have gone up and done that. So you're just trying to sort of tick off reasons to be bullish, to be bearish. You could try and run this all day and try and score it and score it and score it. I think it gets a bit complex, because the thing you end up with is a situation where by doing one thing, it doesn't just negate bearishness, it's actually overtly bullish. Equally, by being, let's say you've got a market that is ticking all the boxes for bullish and it does this and it trades up here, well, at some point, you've actually not very bullish. Not for any distinct reason, just by virtue of not being that bullish anymore. You're running out of reasons to buy, you're running into many reasons to sell. I think that's probably a point where you'd ultimately kind of flip at least short term to bearish. So you could vary it in a different way if you wanted to sort of view it as short term view, long term view. You go, well, get here, short term it's bearish, long term I'd say is reasonably bearish as well. You might look at it and go, well, short term it's still bullish. It depends quite how short term you want, but try and break it down like that. Just to keep a track as to where you are, just helps making decisions a bit easier rather than just get somewhere and go, oh, it's this, it's this, it's this. So you're giving yourself trouble doing that. I'll probably wrap it up there. If everyone go chasing what the S&P is going to do for the rest of the day. It's just done the test back to the IB to 68. So if anyone was looking at that as the sell, that's potentially it. So I still think 25's on. I'm going to maintain that view until it gets inside the IB. If it can close inside the IB on a profile basis, then I think that the idea dies. But until that point, I still think 25's on. Right, I'll wrap it up there, guys. I will send over the sheet with the exercises. I'll probably send that over tomorrow morning. I'll let you guys have a go at that. There'll be payrolls, so afternoon session will start at 2:30 tomorrow. I'll leave you there.
Where do we find all the stuff?